When you picture the stock market crash of 1929, you probably imagine a sudden, catastrophic event. A single day where Wall Street simply fell out of the sky, dragging the world into the Great Depression. But that is not the whole story. The truth is far more unsettling, because the collapse was not a random lightning strike. It was the inevitable destination of a decade-long joyride fueled by debt, delusion, and a profound faith in an economic fantasy. It was the moment the world learned a brutal lesson. Confidence, once shattered, cannot be easily glued back together by any politician or central bank. Let us cut through the noise and the black and white photos of panicked men in hats. The 1929 crash was not a singular event. It was a process. A slow, grinding finale to years of excess that built a tower of cards so high, a gentle breeze could have toppled it. And if you believe this is just a dusty tale from your grandparents' history books, you might want to pay close attention. The very same ingredients are simmering in our financial system today. Mountains of cheap money, frenzies over speculative assets, and a pervasive culture that whispers the seductive lie that markets only ever go up. The true story of 1929 is not about how quickly you can lose your fortune, but about how easily we convince ourselves the party will last forever. The stage for this grand tragedy was set during the Roaring Twenties, a decade of explosive prosperity, dazzling consumerism, and technological marvels. Having emerged from the First World War as the planet's undisputed economic powerhouse, America was booming. Factories churned out automobiles, radios, and refrigerators, completely reshaping daily life. Cities swelled, wages climbed, and millions of ordinary Americans became disciples of a new religion, the belief in endless abundance. It was a beautiful, shimmering illusion, but beneath all that jazz-age glamour, the foundation was riddled with cracks. While city dwellers danced, farmers were sinking in debt as collapsing crop prices turned their dreams to dust. An obscene amount of wealth was concentrated in the hands of a few industrial titans, which meant most families had virtually no financial cushion for a rainy day. And the banks, they were operating with the kind of light regulation and reckless abandon you would expect from a teenager with a new sports car, lending money to practically anyone who wanted to gamble on the market. The stock market quickly became the national casino. Between 1921 and 1929, the Dow Jones Industrial Average skyrocketed from a modest 63 points to a dizzying 381, a nearly six-fold surge in just 8 years. This was not just a game for Wall Street insiders anymore. For the very first time, millions of middle-class Americans, from teachers to factory workers, poured their savings into stocks, utterly convinced they were riding an unstoppable wave into a new economic paradise. Brokerage houses popped up across the country like mushrooms after a rainstorm, and the media fanned the flames, promising untold riches to anyone with the nerve to borrow and buy. And borrow they did. The defining feature of this magnificent bubble was something called margin trading. It allowed investors to put down as little as 10% in cash and borrow the remaining 90%. Let that sink in. With just $1,000 of your own money, you could control $10,000 worth of stock. As long as prices kept climbing, this leverage was a magic wealth multiplier. But the system had a fatal flaw. The instant prices began to fall, brokers would issue margin calls, demanding investors either cough up more cash immediately or have their shares sold from under them. This created a financial time bomb. The higher the market soared, the more fragile its foundation became. One tiny slip, and the entire pyramid would be obliterated by a cascade of forced selling. Even the supposed adults in the room were feeding the delusion. In early 1929, the head of National City Bank, Charles E. Mitchell, proclaimed there was absolutely nothing to worry about. President Herbert Hoover was promising a chicken in every pot, a car in every garage. And in one of history's most spectacularly ill-timed predictions, the great economist Irving Fisher announced in October 1929 that stock prices had reached a permanently high plateau. These were not foolish men. They were the intellectual and financial giants of their era. But intelligence, it turns out, is a poor defense against the intoxicating pull of collective euphoria. The warning signs were there for anyone willing to see them. By 1928, the Federal Reserve started nudging interest rates higher to try and cool the speculative fever. But it was far too little, far too late. The credit had already flooded the system. In September 1929, the market hit its peak, and the first hairline cracks appeared. A few of the largest, savviest investors began to quietly cash out, smelling smoke before anyone saw the fire. Then, in the final week of October, the dam did not just crack, it disintegrated. October 24th, a day that would be immortalized as Black Thursday, saw a tidal wave of panic selling hit the market. A record 12.9 million shares were traded. A coalition of powerful banks and firms tried to play hero, pooling their money to buy up stocks and project an image of stability. For about 24 hours, it seemed to work. But by the following Tuesday, October 29th, the panic returned with a ferocity that was biblical. Over 16 million shares changed hands. The ticker tape machines, the era's equivalent of real-time data, fell hours behind, leaving investors blind to their own ruin. Entire fortunes, built over years, were vaporized in a single afternoon. The myth of endless American prosperity was officially dead. But here is the critical distinction that most people miss. The stock market crash did not directly cause the Great Depression. It was merely the spark that ignited a bone-dry forest. The real catastrophe was the profound fragility of the entire financial system and the series of catastrophic policy errors that followed. Banks had been lending with reckless abandon, holding nowhere near enough reserves. When the loans went bad, the banks simply collapsed. Between 1930 and 1933, more than 9,000 banks in the United States failed, taking the life savings of millions of people with them. With credit completely frozen, businesses could not borrow, production ground to a halt, and unemployment soared to a staggering 25%. This was no longer a Wall Street problem. It had metastasized into a global depression. The crash revealed just how thin the veneer of prosperity had been all along. Between 1929 and 1932, the stock market lost nearly 90% of its value. That peak of 381 points on the Dow Jones plunged to a pitiful 41. Imagine an entire generation watching their retirement funds, their investments, and their dreams evaporate before their eyes. Families who had borrowed to the hilt to join the boom now found themselves drowning in debt with worthless collateral. And even the cautious savers were not safe, because when your bank failed, you lost everything. There was no federal insurance, no safety net. If your bank went under, your financial independence went with it. As if things were not bad enough, governments then stepped in and made them exponentially worse with policies that seemed logical on paper, but were devastating in practice. In 1930, the United States passed the Smoot-Hawley Tariff, which massively raised taxes on imported goods to protect domestic industries. Other nations immediately retaliated, and global trade collapsed by over 2/3 in just 4 years. At the same time, leaders clung desperately to the gold standard, believing it was the only way to maintain currency confidence. This policy forced them to tighten the money supply when they should have been stimulating the economy. The nations that abandoned gold early, like Great Britain, started to recover sooner. The United States, stubbornly holding on, only prolonged the agony. By the mid-30s, the Depression had fundamentally reshaped the world. In Germany, the economic despair created a fertile ground for extremist movements, providing an opening for Adolf Hitler. In America, Franklin Roosevelt's New Deal was a massive series of experiments in public works, banking reform, and social safety nets. The Securities and Exchange Commission was born to regulate the markets, and the Federal Deposit Insurance Corporation was created to insure bank deposits. These were not just bureaucratic tweaks. They were a desperate attempt to restore trust in a system that had profoundly and utterly failed its people. The lesson was brutal. Without rules and confidence, the machinery of capitalism simply devours itself. Now, let us zoom out for a second. Why should any of this matter to you today? Because the psychological machinery that created the 1929 crash is not a historical artifact. It is a permanent feature of human nature, and its echoes reverberate through every single economic bubble since. Think of the dot-com mania of the late 90s, where companies with no profits were valued in the billions. Think of the 2008 financial crisis, fueled by a housing bubble that nearly took down the entire global economy. The assets changed: tulips, railroads, tech stocks, crypto, but the cycle remains hauntingly familiar. Easy money fuels a speculative frenzy, the bubble pops, and everyone starts looking for someone else to blame. What is truly astounding is how the exact same phrases from 1929 are reborn with every new cycle. This time is different. We have reached a permanently high plateau. The fundamentals are strong. These are not statements of fact. They are the mantras of denial, chanted by those who have too much to lose to admit that the ground is crumbling beneath them. The crash of 1929 serves as a permanent reminder that the most dangerous words in finance are not about fear or panic. They are about complacency. So what does this mean for us right here, right now? Take a look at the landscape. Asset prices across the board, from stocks to real estate, have been inflated by more than a decade of near-zero interest rates and unprecedented central bank intervention. Governments, corporations, and households are buried under mountains of debt, and new technologies have opened up new speculative casinos for a new generation of gamblers. Just like in 1929, millions of ordinary people are convinced the game is rigged in their favor, that prices only go up, and that the system will ultimately protect them. But history tells a much colder, harder story. When confidence finally cracks, that protection vanishes, and those at the bottom of the pyramid are always the first to be crushed. This is where the story connects directly to you, and it is the most important part. Ask yourself this question honestly. If the system wobbled tomorrow, if credit markets froze, if asset prices were cut in half, how prepared would you be? Would you be the margin trader of 1929, leveraged to the eyeballs, one phone call away from being wiped out? Or would you be the investor who understood that true wealth is not a number on a screen, but real, durable value that can weather a storm? History does not repeat itself, but as the saying goes, it certainly does rhyme, and the tune it is humming right now should make you very uneasy. The real lesson of 1929 is not about panic. It is about resilience. The wealthy of that generation, those who diversified their assets, who understood the cycles of boom and bust, and who did not get swept up in the mania, not only survived but often grew stronger. The vulnerable, those who borrowed too much and chased easy money, were financially obliterated. The story of 1929, stripped of its panic and myths, is not just a history lesson. It is a mirror held up to our present moment, forcing us to ask a very uncomfortable question. Are we any wiser, or are we just more sophisticated in our delusions?